Hi, good morning, good afternoon, and good evening from wherever you're attending this session from. Thank you for being here and listening for the next 20 odd minutes to what I am trying to describe as a great effort to build a consortium of blockchain, which includes banks and other specific stakeholders, where we have used permissioned networks, private transactions, and eventually now the next big thing in blockchain technology, which is decentralized finance. So let's get started. A brief about me: I'm co-founder at a company called World, which is India's largest blockchain platform and now extending globally. In addition to that, I am a blockchain author, a regular blockchain speaker, as well as a visiting faculty in blockchain across few of the institutions. My purpose for the next 20 odd minutes, as I said, would be to explain the nitty-gritty of the infrastructure that I just spoke to you about, to be able to analyze carefully the consortium of blockchain that we've built. That is a good use case to understand where can permissioned blockchains be useful and what additional features can permissioned blockchains take up. For example, and very useful, private transactions, which is extremely useful in cases where you have to make sure that all parties do not get access to every other party's transactions. Just like I said before, banks are involved in this case study, which means that banks don't want to share their information. For example, if they want to give a loan or if they are doing any other transaction or deposits, they do not want that to be known by any other bank in the network. This is what that means. And privacy in terms of transactions, of course, you understand that all transactions in a blockchain network have to be written in their ledgers by every node in that network. So this is what brings in the question of anonymity or transparency, where some banks do not want all of the transactions to be visible, which means that all of the data of that transaction to be visible to other banks in the network. So we will see that what this case study entails in the use of private transactions. And finally, the kind of paradigm shift that the next big thing, which is decentralized 2.0 or decentralized finance 2.0, can bring in, and what can a global impact it can create. Let's take a look. So we start by explaining this case study, which is about a financial model called warehouse receipt finance. The WHR you see on screen right now stands for warehouse receipt finance. An interesting fact about warehouse receipt finance is that warehouse receipt finance is one of the oldest lending products available or known to mankind. But it has been slow, it has been filled with problems since forever, since decades. Now, with the use of blockchain technology, we can take this up in today's discussion as a very viable case study where there have been humongous changes based on the introduction of blockchain technology, due to the introduction of not only just digitization, but digitization with the help of a complicated technology like blockchain, in turn making the lives of the stakeholders very easy. What are the kinds of stakeholders here? We'll just take a look later on. But let's try to understand what even this model is all about. Warehouse receipt financing is a very simple 4-step process. First of all, let's consider a farmer as an example. That is one of the stakeholders in this entire ecosystem. Similarly, just like farmers, it can be an agribusiness, a trader, an exporter or an importer, an FPO, or which is a farmer producers organization. Any of these stakeholders can take a part in this warehouse receipt financing model and take benefits of this entire financial lending product. So let's assume for our example that the farmer is a borrower in this particular model. That farmer harvests their crop. Let's say, again, take an example of 1,000 quintals of rice. Again, for example. Now they have two options. They can take their 1,000 quintals of rice and sell it in one of the nearest markets. That in any market that we are talking about, in any region that we are talking about, not just a country like India, Bangladesh, or any other APAC country, but also countries like Australia or Singapore, Indonesia, and the Colombian market. These are some of the places in our case study which we have already looked at. And we are very much sure that it is also the case in other markets, other agricultural markets as well. And what is that case? It is that right after harvesting, the total cost that a farmer gets per kilogram of a particular commodity, say for example potatoes, or in this case, let's say rice, will be very low. It will be pennies on the dollar. On the other hand, if they sell this produce after 2.5 or 3 months, they would fetch much better prices against their commodities. How much better? Just in India, we've taken a look at it, and it's approximately 35 to 40% more, which is an increment in their income. In places like Africa, this is 3 times the increment in their income. No reason we would not encourage someone like farmer who can be a smallholder farmer. They are not well to do. They have less than a couple of hectares of land. And now they've waited for months to harvest their produce, and right after harvesting, now they go into the market and get pennies on the dollar. That's not justice. That's why in this case study, we encourage them to avail this product called warehouse receipt financing. How do they do that? So this is the second option that they have. They can take their 1,000 quintals of rice, which we took as an example, and deposit it in a nearby warehouse. In return, they would get something which is called a warehouse receipt. That, as you can see, what is WHR stands for. That warehouse receipt will have all the details about their commodity that is stored in the warehouse. Which commodity, what grade, which variety. For example, if it's rice, a very popular variety is basmati, for example. Similarly, what is the tonnage, every other detail, what is the current price per unit, all these details are stored, are fetched from the blockchain directly, and it is available on the warehouse receipt. Now that is where blockchain also comes into the picture, but we will come to that later on. After that, a unique proposition is that the farmer can take his warehouse receipt, can use his warehouse receipt as a collateral and take loans from a bank, which would mean that this is a collateralized loan that a bank can provide, and which is very, very secure. And now this has been happening since so many decades, you can say. But this usually takes about 13 to 15 odd days for the farmer to avail. Again, does not help for a farmer who's waiting for the harvesting season to happen so that they can harvest and then sell it off in the market just to get their capital in their hands. They need to run their homes. They need to get their children educated or married. All of these are expenses for which they need money, and they have been waiting for this harvesting season. So now they take this loan from the bank, which fulfills their purpose of this capital. Going ahead, they can, after 3.5 months, when the prices in the market for their commodity is much better, they can sell it off in the market and they can fetch much better prices. Till then, it would be stored and it would be held in the warehouse and in a secure format and in a very collateralized form against which the bank has given a loan. That is what the model is all about. So let's take a look at why was this even necessary? Why did we even build a use case, or even discussing today a use case which is built on blockchain technology that caters to a very specific segment such as warehouse receipt financing? This is not a small segment. This is a humongous segment. And so are humongous the frauds that happen in this segment. Since decades now, similarly as this warehouse receipt finance model has been active, banks in this segment have faced billions of dollars of very regular frauds. You can see on the screen, almost every year you can take a note of 2020 to 2017, 15, 19, 18, 13. All these years you can see have seen some humongous frauds happening. Qingdao scandal back in 2013, that's more than about $670 million. In India itself, there have been billions of dollars of frauds. This takes back the economy way years back. So that's one of the critical reasons why we can call this warehouse receipt finance market to be broken. In addition to that, because of the manual process, there is a high intermediary cost, which translates to not only just high turnaround time, the high TAT, also it leads up to high cost of lending as well as high cost of borrowing. That is why farmers and banks would both want to pull out of this entire segment. In addition to that, the portfolio is very concentrated on high ticket loans, or mostly traders, and farmers don't get the benefit because they are low cost traders. Also, the system is largely manual. Even after so much of digitization, it is still largely manual with a lot of intermediaries. So in this case study, we introduce a blockchain ecosystem to solve the frauds problem, the manual intermediaries problem, and the high cost problem. Let us see how. On the screen right now, you can see that there is a very clear demarcation of how this kind of a system can run or has been running. This is where you can see that there is a part of the segment or a system which runs on the blockchain, which is the on-chain part, and also a part of the ecosystem which runs off the chain, which simply means that the on-chain part reads and writes to the blockchain. On the other hand, the off-chain part does not write to the blockchain, and in some cases only reads from the blockchain. On the off-chain part, that's where the journey can start. It starts with the farmers. As we took an example early on, the farmer can make use of a simple Android mobile app, such as the digital lending mobile application, as you can see here on the top. That would actually push data not to the blockchain because they do not write on the blockchain, but on the other hand, they would be able to interact with other systems in the same stakeholder network. For example, using this digital lending mobile application, farmers can not only take a look or search for a nearby partner warehouse where they can store their goods, they can also later on fetch their warehouse receipt. You remember the warehouse receipt is the piece of is a piece that gives them the piece of paper that gives all the details of their commodity. In addition to that, they can later on use the same mobile application to ask for a loan, to raise a request or a loan application that goes straight to the bank. This is where the process gets cut from 13 to 15 days as a TAT, which I shared earlier, to less than 5 minutes. That's mostly a real-time loan, something that farmers or traders in this segment have never ever experienced before. This is like magic for them. In addition to that, later on, using a similar kind of an app or using the same app, they can trade off their commodities as well, all from the comfort of their home. Especially in the situation of a pandemic, there is nothing better than this. In the meanwhile, the entire ecosystem is working on the blockchain network. The blockchain network contains nodes such as the warehouse, the bank, a verifier agency, and any Oracle price point that gives real-time data or real-time price of the commodities into the blockchain system, which is then used by the smart contracts that are running. In this case, the warehouse node is the place where the farmer is depositing their goods. The bank is the one which is giving out the loan, and the verifier node or the third party is a collateral manager which the bank is appointing for assaying or assessment of the goods in physical form in the warehouse. All of them are nodes on the network, and this way, as more and more warehouses become a part, as more and more banks become a part, the number of nodes increases on the blockchain network, making the network super strong. Currently, in this case study itself, there are over 1,400 warehouses which this case study is deployed on already. What kind of experience or what kind of benefit does this kind of a network gives? You can see that there are two ways to be benefited from the system. As a quick look, borrower or receipt related frauds, which means fake or forged receipts, multiple lending against the same collateral, or lending 4 to 5 times beyond the capacity of a warehouse, which technically means that you are lending against something called ghost collateral. And you can see that there are immutable receipts, then other benefits such as lending stops at 100% of the warehousing capacity, and removal of ghost collateral cases, which is provided by the blockchain system by providing real-time information or real-time outlook into the status of a particular receipt or a set of receipts to the bank before giving the loan. Now, after talking about the use case, let's take a look at the next topic which we wanted to discuss in this agenda is what is the kind of blockchain system that we are talking about building or have built in this particular use case. The basic general architecture of this would be similar to as we have seen in the past. This is how blockchain systems are built, and you can see that it starts from an infrastructure layer, goes all the way above to data layer, network layer, then consensus layer. Here is where consensus mechanisms such as proof of work, proof of stake, DPoS, others are used. We use something called Raft as the consensus mechanism, which is very, very suitable for this kind of a network. On top of it comes the application and presentation layer, where these all panels and products such as the app, the web-based panels given to all the stakeholders to interact with the blockchain are provided, and they run here. This is what in this case study we have used. We have used the Quorum blockchain, which was originally built by JP Morgan and later acquired by Consensus. This is how it runs. It is a separate Quorum node which is held by every stakeholder such as the bank, the warehouse, the CMA, everyone. The Quorum node or the entire Quorum ecosystem has a very specific attachment or an element included in it, which is called the privacy manager. This is where a system like Quorum differs from a public system like Ethereum. This is the advantage of blockchains like permission blockchains like Quorum. You can see here that the privacy manager has further components such as transaction manager as well as enclave. These very beautifully work together and handle the encryption parts of a transaction. As you can read on the right side, Permissioning and privacy. The core two concepts that we wanted to discuss in this use case and this session are that the quorum provides right out of the box these capabilities of permissioning, which means that creating a permissioned ledger or a permissioned blockchain network with these stakeholders such as the banks, warehouses, etc. And also providing the element of private transactions, which, as I explained earlier, in this case, banks would not want their loan details to be displayed across the entire network as a public measure. That's why banks would want it to be private, and hence only the stakeholders such as the warehouse and the bank involved in a certain loan should only be able to look at the transaction. That does not mean that other nodes will not be writing the transaction in the ledger. That's how a blockchain works. But the use case or the element of private transactions helps with that only. This kind of a feature helps in everything to be encrypted for every other stakeholder, which are not privy to this entire conversation between one bank and another stakeholder. So there are certain three questions that we want to answer here. First question, coming to DeFi. Now, this is the place where we have already discussed the current use case or the case study that has been running in this entire blockchain ecosystem. Now, this means that a permission node implementing private transactions is running as a consortium of banks and other stakeholders. Now we are talking about connecting it with the next big thing in blockchain technology, which is decentralized finance. You can see here that we are answering three questions as we step into the connection or the bridge between the system we just discussed and decentralized finance or DeFi 2.0. That's what it is all about. I'll just discuss in a matter of minutes. First question. Befitting use cases of DeFi are to create a meaningful replacement of centralization, something that helps in most of the use cases of supply chain management, then warehouse receipt finance, then other fintech products, etc. A very good example of this is being done by Compound Finance, which the logo you can see on the screen, as well as someone called Brew Finance. In addition to that, scale is of paramount importance, which means that we have to have a global impact and it has to be scalable. That's when you are able to use blockchain technology for everyday use. A good example is Maker. In addition to that, the final is the social impact factor, or is it just glitter, or you're actually able to create some impact into some of the segments of this world. Just as we discussed earlier, and we took the example of farmers, especially smallholder farmers, this means that this kind of an application is able to create a massive impact in the lives of smallholder farmers. A very good example is World, which has been given support and grants by United Nations Development Program, then other business schools, Government of India, etc. A very good use case. This is where the story becomes interesting. We are talking about the two killer use cases of crypto, DeFi and NFT. However, they are very, very diverse at this moment. We are talking about, in this use case, connecting both of them, building a bridge that actually connects the $4 trillion worth of a market in the real world asset lending and connecting it with the decentralized finance, introducing decentralized finance to this massive market. That changes everything. So what is the kind of solution we are talking about? We are talking about bankless lending by doing decentralized finance on real assets. Just to clear out the story for you, earlier we discussed creating a permissioned blockchain consortium that deals with private transactions and permissioning of banks and other stakeholders. That is a use case that has been built already, and that is a use case that has been deployed across 1,400 warehouses. Now we are talking about taking that $500 million worth of transactions which a network has, which we discussed earlier, to the decentralized finance world. Which means that now we are bridging both those worlds, which hasn't happened yet. You can see, which we took a look at earlier, that this is the centralized format of the use case, which runs with stakeholders such as the warehouse, the banks, the verifiers, etc. But here is where we replace the bank with the entire decentralized pool of funding, which is cross-border, which has a completely global impact. And the crucial ingredient here is the proof of reserve. You can see here that how the bridging can happen and what kind of benefits it can bring on. Now, let's try to understand, as we said earlier, that why DeFi against commodities and what are the benefits. So lending against real assets with liquidity, unlike illiquid assets such as real estate. Hedging against inflation. Commodity prices are directly proportional to inflation. You have that covered. Global ownership from smallholder farmers to traders to large corporates across continents. You have that covered as well. Then comes proof of reserve, which I said is the most critical element to validate real life components of the transactions. And then finally, bankless finance with social impact. To smallholder farmers, this means an increment of up to 40% in places like India in their income and up to 300% in other places like Africa. And that's pretty huge for someone with a meager income who has less than a couple of hectares of land. All right, so that was the benefits. That was the entire case study that we have tried developing and understanding here, that what can it mean to connect an entire consortium of blockchain technology, which includes banks, warehouses, collateral management agencies, an entire fintech lending product with the use of blockchain technology and with specific elements such as permission networks or permission nodes, then private transactions, and then finally to be able to connect that traditional finance, or as we call it TradFi, the TradFi network, the TradFi ecosystem with the decentralized finance ecosystem, or the next generation or DeFi 2.0, which brings in decentralized finance on real world assets, which you know that till now is only on crypto assets or crypto currencies, or whatever part is there is against synthetic assets or digital twins. That's all what 100% of the crypto DeFi ecosystem comprises of. That's what DeFi 2.0 is, bridging the TradFi to DeFi and bringing lending and other decentralized finance products on real world assets. This is a humongous case study, and I hope you enjoyed it. You understood a great deal about all these sets of technologies from the concept point of view as well as the technical point of view. Please reach out to know more, to understand the depth of this entire beautiful case study, which has received support from United Nations Development Program, IIM Ahmedabad in India, then Government of India and other universities as well. Thank you. Would await your questions and other feedback.
Hello everyone, my name is Vitaly. I'm the CEO and founder of AppLabs, and today we will be speaking regarding automating KYC and onboarding to enhance the customer experience. Let's start. KYC today is a significant element in the fight against financial crime and money laundering. And customer identification is the most critical aspect, as it is the first step to better perform in other stages of the process. KYC, or Know Your Customer, is a set of operations to identify an existing user. Usually these operations have like the next stages: ID card verification, face verification, document verification, such as utility bills as proof of address, and also biometric verification. Also, you can see here the agenda for today. The first step, why is KYC important? Who needs KYC? Challenges of traditional KYC, main principles of automating KYC, solutions for KYC automation, the main problem for recognition technologies, and KYC in different countries. So let's proceed. Why KYC is important? First of all, we understand that it helps identify and prevent money laundering, terrorist financing, and other illegal corruption schemes. KYC covers a host of legal standards and regulations which businesses need to comply with. For example, anti-money laundering and customer due diligence. Second of all, KYC, the customer's identity needs to be verified by banks and financial institutions against public record databases before users' accounts can be opened and transacting through the system. That usually includes different checks like checks in the list of terrorists or sanction list and other politically exposed people and people under sanctions. According to regulations, banks and financial institutions need constant monitor existing customers on a frequent basis to identify any risk connected to them. KYC can be done via offline or online channels. Let's have a look what the difference between those channels. Offline channel. In this way, the customer should download the onboarding application. He or she fills in the details in the physical document, signs the document, and submits it along with the copy of required document and paperwork. Online channel. Here, the customer uploads the required documents and fills in the details required in an online form, and all documents and the person will be verified either automatically or by manual reviewers. So online channel could be divided in two different processes, automated process or manual process. Speaking regarding the goal of automated process, it's well understandable that if the system verify everything online, I mean the user will receive the better onboarding process and faster onboarding process. So for all of our software that we have done for our clients, the goal is to optimize the percentage of the users that can go through the KYC process automatically. In this process, we have like few different stages. First of all, it's like document type identification, document ID reading, face matching between the user who is going through the process and the document that this user provides. It could be done like through the 2D and 3D liveness detection. And also, we should verify whether this person is a politically exposed person or not. If there is any issues, then we should send the person to the manual procedure. Manual procedure usually done by a reviewer who can schedule the call with the client and go through these steps during this call. Well, to validate documents, to validate that the person is real or not, we had actually some cases when our system identified that the document that provided by the user is the document that usually the person in prison can have. And in these cases, our system for sure will send to the manual verification to understand that this person is not in prison. Also, our systems that we have done verified many other interesting cases I will share with you later. So let's have a look who needs KYC. First of all, we understand that many financial institutions like banks and credit institutions, insurance companies, also fintech service providers, e-wallet services, e-currency services, mobile or digital banking, foreign exchange brokers, digital or cryptocurrency exchange platforms, and other, including like even estate agents, legal professionals, assets manager, and many others. Let's have a look at some cases from our experience of using 2D and 3D liveness detection. First of all, I should mention that 3D liveness detection usually should be in use when the user has issues with the internet or the internet connection is not very stable. And 3D liveness detection usually in use with the more stable internet providers and internet connections. Regarding these processes, 3D liveness detection usually creates the 3D mask by moving the face in the left, right, or so on by user. Speaking regarding 2D liveness detection, it's more about taking the picture with the person and his or her documents. Usually, we found a way that for the 2D liveness detection, there are a lot of the cases when the person tries to make a photo of another device. That's why we found a way that if we pre-record or record the small video stream before taking the picture, we can understand whether the person is trying to trick the system or not. And it helps a lot for many different solutions of our client that we have implemented. Speaking regarding 3D liveness detection, this approach is more accurate. The percentage of accuracy of 3D liveness detection is around 85%, which is very high, I would say. Also, we have done a lot of different software for lending platforms, and we had a lot of interesting cases in there. In our practice, we had an example of people to take the credit being in a prison, and we implemented these solutions in the way that they managed to identify that the person is in prison or not, based on different aspects like clothes on the person, the type of the document that the person provides, sometimes whether the person has clothes or not. We had also cases when the person tried to go through KYC without having any clothes, so they were banned. Also, we had the cases and managed to recognize them when the person was beaten to take a credit. So we implemented different solutions in a way that they can understand whether the person has some bruises on their face or not. And that helped a lot for many our clients. Also, speaking regarding our experience, we have done different approaches for many different clients. So we did even integration for KYC process with worldwide services like FaceTech, Os4NCs, or Veriv. And also there were solutions that we have done everything from our end. Sometimes we were using open source libraries like OpenCV, TensorFlow, or Keras. So with different set of the third-party libraries or services, we have done these cases and covered many interesting cases for our clients. Let's have a look at challenges of traditional KYC. And the first one is changing regulations. We all remember the GDPR compliant, which was released in May 2018 regarding transparency of holding customer sensitive information. Also, according to the European Union Fifth Anti-Money Laundering Directive released in January 2020, all platforms offering exchanges in virtual or cryptocurrency will be the subject to stricter controls. Exchanges are now required to register with the relevant competent authorities and conduct customers' due diligence to comply with anti-money laundering, AML, or KYC. The second challenge is lack of all-encompassing technologies. Outdated legacy systems or lack of the proper system require a lot of intensive input. And not all banks or financial institutions can meet KYC regulation easily at this moment. Also, the challenge is a high costs. Major financial institutions have reported spendings anywhere from 50 millions to 500 million US dollars per year on KYC and AML and due diligence cost. The true cost of KYC includes internal salary wages, third-party identity verification, technology development, third-party licensing, regulatory fines, and costs of remediation. KYC is time-consuming process, and typical KYC requires verification of different types of the documents. For example, for identification and verification of individuals, there could be in use like passport card, driver license, debit or credit cards. Regarding proof of address, there could be in use also different types of the document, such as utility bills, bank statement, rent agreement, tax bills, insurance agreement, or others. Also, the next challenge is time for digital transformation. We understand that the most efficient way to do the KYC is to do it online and automatically. However, many institutions still require an offline process, and they do this manually. So they need to transform their approaches and processes and go to digital. The next challenge is inconsistency. The various documents requested differ among banks, regions, and countries. So as we had a look at the different types of the document, for example, for proof of addresses, there could be bills, utility bills, bank statement, rent agreement. That means that data could be structured in a different way on these documents, and the systems should understand them, validate them, and only then finalize the KYC process. And the next challenge is security. We understand that the data, the client's data, will be stored on the software end, and there is, as usual, the issue regarding management and storage of that data. So let's have a look at main principles of automating KYC. Let's imagine that you would like to build it from scratch and you just would like to understand how to do the first step. So first of all, measure the current KYC process. If you implemented this KYC process in the first time, you should identify some KPI for your process and measure whether it meets them or not. For us, the very important part was the percentage of the users that goes through automation process without the problem, without going to the manual verification. Understand your requirements. So as we have done many different products for different markets, we understand that requirements is the key. For different markets, countries, regions, there could be some specific requirements in terms of the documents which should be in use, in terms of the data, and so on. So that's for sure the key for you. Use a cross-functional team. So you should understand that you need representatives from across operations, compliance, and technology, because all these three parts will be connected together to build just one solution. Don't underestimate the data challenge. So yeah, the data is a huge challenge, and you need to understand that your KYC process need to be focused on the data, user data, and should be very well with them, understand, recognize, and so on. So that's the challenge for most of the systems at this moment. Agree with third-party approach. Here you should understand whether you would like to build everything from scratch or just integrate with existing third-party services that will help you to cover either some parts of KYC, either optimize it completely. If you remember, I mentioned different approaches that we use, like Fintech or OpenCV, third-party libraries. With the different approaches, we manage to provide different cost effectiveness of this KYC process, cost and effectiveness, I would say this way. And the last rule, test again. If you finish your KYC, you can bring additional number of the users to test and do it like a couple of times, because the testing is most important part of KYC. You don't want to launch the product that won't work very well for your target audience. Of course, there are a lot of the solutions that can help you to optimize the KYC. For example, there are solutions for remote customer identification, identity mind accurate Trunomy, for fingerprint identification, transmit security, Innovation, for the verification of customer bank accounts, which could be done through the Plate. Also, there is many different anti-money laundering automation tools for different regions and markets. For USA, there is Equity, for UK, Comply Advantage, for France, it's UDeal, and many other solutions that can help you to optimize your KYC or delegate some task of your KYC flow for sure. Let's have a look at the main problems for recognition technologies. Probably you understand that the performance of Face ID systems outside a controlled environment is affected by many factors on the user end. All of these factors, they impact the result of identification. The first factor is lighting. A lighting condition should be bright enough to reflect all facial features, but not illuminate them. Also, the position of the head is very crucial, and the face can change when the head is turned. The next problem is the face expression. A neutral expression is ideal for accurate recognition. However, human emotion and mood impact facial face expression. The next problem is aging. Neutral age-related changes in a person's appearance also affect the ability of facial recognition system to authenticate people. Cosmetic intervention and style changes. So changes in appearance due to plastic surgery, makeup, hair changes can negatively affect the accuracy of recognition algorithms. Another item is accessories. The presence of various objects on the face, like glasses, bird, and other or variant accessories like hats, scarves, can seriously affect the recognition system. However, the modern algorithms are working out the ability to see through those objects, and even we have implemented a lot of the product that work very well and can recognize the person that wears some accessories. The next problem is special masking to device recognition system, and that's the bigger problem, I would say. The raw accessories, a combination of technology and fashion that can outsmart the recognition algorithm. For example, lens-like masks, their curvature blocks the face recognition from all angles. Also, there is the projectors that can overlay the image of another person on the owner's face. And even there are glasses with infrared LEDs, special makeups, and other items. The next problem, the masks. After the introduction, the quarantine, a lot of people start wearing the medical masks. And for sure, if the person who will be going through KYC process will be wearing the medical mask, the system won't be able to recognize him or her because the mask will cover the most part of the face. However, I would like to share with you regarding our experience and building different KYC system for, let's say, lending tech products that we had. You as a company can choose which KYC process should this person have in their case. For example, we had the cases when the person would like to lend small amount of money. And in that case, we ask the person to go through the small KYC process and ask only their bank ID. However, if the amount of money that this person would like to lend will be more than limitation, we should apply the liveness detection procedure or ask the user digital signature. Speaking regarding liveness detection, it could be 2D or 3D, depends on the internet connection of this person. KYC in different countries. Let's have a look what we have in some countries in Europe. For KYC, the two most relevant pieces of European legislation are the GDPR and the fifth anti-money laundering directive. For example, in Germany, the requirements imply fifth anti-money laundering, also known as the GWG. Spain requires enhancement liveness detection for KYC. For KYC in France, you will be required a secondary ID document to verify a person. Italy requires 7 additional risk checks. Also, up to 70% of customers use a paper ID there to pass the KYC. From our experience, we also would like to share differences for KYC in different countries. The first difference is biometric identification. For sure, we should understand that there is like big changes in users that will come from one region or a country or another, because the facial features of those people could be different. For example, if we say that through the system will be passing a lot of Asian people and European, the algorithm should be able to recognize these two different group of people. So that makes additional changes. Also, local regulation, we just mentioned on the previous slide. For sure, for different countries or region, there will be different integration with their verification or bank systems to understand that the document is valid, this user is a real one. So probably you should understand, if you would like to build your system, there will be a lot of challenges down along the road, which you will face, and you should be ready to them. However, we have done a lot of the product for our clients, and we have passed them already together with our clients. At this moment, I would like to say thank you for your attention. I will be happy to answer on your question. You have my email address, LinkedIn profile. You can use this QR code to get in touch with me. We'll be happy to get connected on the European Digital Week. See ya.
Hello, my name is Roberto Capodieci, and I will talk to you about decentralization and blockchain. Let me start with something we all can relate to. We all have been through the ICO craze. We all have heard that these startup pitches going like, we are a customer-centric organization and we deliver the value of IoT, cloud, big data, machine learning, and artificial intelligence by using design thinking to drive digital transformation for blockchain-connected enterprise. Then you wonder what they do, and at the end it's just another token. We have launched this new token called Decibel Coin. How does it work? You just yell into your microphone to get money. It is, ready for the pun, it is a sound investment. Okay, let me make an NFT of the joke and sell it on OpenSea. Let's take a look at how we got here, so that we can better understand where we are headed to. We are living in what is called the information age, also known as the computer age or digital age. Humans have been through the Stone Age, the Bronze Age, yes, I'm starting from the beginning, and is in the Iron Age where technologies start being developed. I'm not saying that cavemen were building microchips, but an ongoing evolution of some rudimental technology led to what a couple of thousand years later became the Industrial Revolution. The Industrial Revolution is divided into subsets. For the developers, we're talking about arrays of arrays. So there is the first Industrial Revolution based on steam power used to mechanize production, the second Industrial Revolution based on electric power to achieve mass production, and the third Industrial Revolution based on electronics used to have a smart production. And now we are in what some call the fourth Industrial Revolution, but I prefer calling it the information age, that is based on data, information, used as service and product. The information age is also divided in subsets. Again, for the developers, we're talking about arrays of arrays of arrays. We had the initial phase where analog content started being stored and shared in digital format. A second phase where this digital content could be sent and enjoyed over networks and eventually the internet. A third phase where services are sold and provided by individuals and companies through the internet. And the fourth phase, which has just begun, where those products and services are offered by the community to the community, the decentralization phase. Now to the point. Soon, protocol for decentralized system will start replacing those of centralized web services that currently dominate the internet. When rather than connecting to the API or some central provider, our application will interact directly with a peer-to-peer network, we will be a step into a decentralized internet. When rather than connecting to an ISP, there is effectively a man in the middle between our computer and the rest of the internet, we will connect to a random hotspot of a global mesh network, then even the internet as infrastructure will be decentralized. There are several tools to decentralize, and blockchain is one of the prominent technology currently used. We all know that Bitcoin, while it has the merit to have brought to us the concept of blockchain, is just one of many decentralized services that can be run on a peer-to-peer network. The adoption of blockchain is moving beyond cryptocurrency use cases. This is happening because blockchain protocols are open and anyone can implement on top of them, clone them, modify them, and most importantly, make them better. Here is a quote from Fred Ashram. Blockchain are digital organisms. As organisms evolve through changes in their DNA, blockchain protocols evolve through changes in their code. And like biological organisms, the most adaptive blockchains will be the ones that survive and thrive. Please note that we're talking about bottom layer blockchain platforms, not the application developed on top of them. The need to evolve is big. Most blockchain technologies, consensus systems, transaction types are thought of with a cryptocurrency in mind. This goes down to the core of how a blockchain is secured, making this platform weak and prone to attacks if adopted on non-cryptocurrency related use cases, or when managing titles of a value higher of the blockchain internal economy. In simple terms, those blockchains are secure until the return of investment of a cost of an attack makes the attack viable. For example, using current consensus systems, blockchains that are susceptible to attacks are those that manage title worth much more than the blockchain own market cap. For example, ownership title like warehouse receipts. And those used to decentralize the management of data with no real need of a cryptocurrency. For example, documentation flow, such as medical records. To decentralize and be really decentralized, a blockchain should have no administrator, no central controller authority, or even no influential charismatic leadership. In a blockchain, each user owns and controls their data. The blockchain replaced the need to trust a third party with the cryptographic proof of what happened, when it did happen, and the guarantee that it did happen following the protocol rules hard-coded in the blockchain core software. A transaction that does not respect the rules is not processed. I cannot send them Bitcoin if I don't have them. Blockchain must be seen as a decentralized system with tools to cryptographically secure data transformation. Blockchain provides the possibility of having scarcity and thus even the singularity of digital assets, something that in the digital world was impossible just a decade ago. Blockchain makes it possible to reach a consensus about the current state of a piece of data without having to trust any third party to tell us what the current state of the piece of data is. Blockchain has the potential in the near future to fundamentally change how we share information, buy and sell things, and interact with each other and with the institution. We will use blockchain to prove our identity and even verify the authenticity of everything, from the food we eat to the medicines we take. And most importantly, people will own and control the data that belongs to them. We all know that hidden layer technology, think databases, are often the hardest for users to relate with, as they're invisible to them. This is a problem for blockchain as well, and its adoption has been made worse due to the often negative association with illicit activity allegedly done with cryptocurrencies. A good narrative is necessary to accelerate blockchain adoption and gain the needed trust for technology to be accepted in multiple industries. Furthermore, blockchain is like the new cloud, big data, artificial intelligence. Too many people are using it as a buzzword without even knowing what they're talking about. Blockchain should be used to solve real problems, but unfortunately, it is often forced in projects without a real need for it, just for marketing purposes. A real working decentralized system has no centralized ownership or point of control, and it belongs to the people running its peer-to-peer network nodes. Companies that create a real decentralized system hand them over to the public, remaining with no control over it, besides maybe owning a big chunk of its economy. The node application code is in the hands of the open source community, and the full project is public. Once the system is public and its code is open source, then the project is really decentralized. The public members who support the funding of the project directly contribute to the development process done by the open source community. Those that run a node of the system peer-to-peer network are contributing to the system itself by running the network, creating collective value, and strengthening the system. They should be monetizing from the user activities. When users pay for a service consuming the peer-to-peer network, those payments should be split among the peer-to-peer node owners. Node operators need in fact to be compensated for the processing power and cost which they have allocated to run their nodes. Current system reward only the accounts that create new blocks, while the rest of the network remain uncompensated. The way to go is reversed. Punish the accounts that do not create a block when they should. Let's pay attention. I'm not saying that there should be no way or opportunity for businesses to monetize on the decentralized services. What I've been talking about until now is the lower layer, the blockchain platform itself, which needs to be really decentralized. Yet, decentralized application built on top of an open and public blockchain may have a central point of control, an administrative account, user levels, and specific monetization method. There is a world of services to be implemented and that are being implemented, starting from hybrid apps that use blockchain just for some of their processes, to DAOs, applications that are fully working on the blockchain. Many of these decentralized systems will replace existing online services and applications, but others are new and will never have to have the chance to exist if a decentralized platform to run them didn't exist. Blockchain, and more widely decentralization, offer great opportunities, and we need to focus on and use those when deploying new projects. Let me tell you the story of what I believe is one of the biggest missed opportunities when it comes to decentralization in recent history. We all know what torrent is, right? I'm sure none of you has ever done this, but torrent is a peer-to-peer protocol for a network mostly used to download pirated movies and music. Well, torrent is decentralized in its nature as it is a peer-to-peer network and is the first file sharing system authorities have not been able to shut down. Torrent is at the basis of what a blockchain is today. A blockchain cannot be shut down if it runs on a solid protocol. As I'm heading to the end of this talk, as promised, I leave you with an interesting story. Title: The Missed Opportunity of the Music and Movie Industry. Consumers always bought music and movies, and those with a more criminal mind made copies of the music cassettes and VHS tapes to their families and friends. This behavior was tolerated as the loss of quality of the audio and video in analog copies made the chain of copies quite short. Flashback to the beginning of the speech. As we entered the first phase of the information era and content became digital, people started making copies of CDs and DVDs. At this point, there is no loss of quality, as digital copies are as good as the original. For this reason, digital copies were much less tolerated. But it got worse. Huge drama, screaming, people running desperately in the corridor of the music and movie industry office, management pulling hair off their heads. I'm just guessing. As soon as we entered the second phase of the information era, and digital content can now be copied over the internet. The music and movie industry lobbied the government to shut down any website, forum, and online file storage that was used to trade pirate content. Napsters have been the last to stand. The music industry litigation worked against them, and Napster was served with an injunction and shut down its server in 2001. But then Torrent came along, a peer-to-peer network that simply cannot be stopped. The music and movie industry, now together with the software industry, as software piracy over peer-to-peer network were also rampant, lobbied the government to arrest the final users, calling them pirates. Under the US law, IP infringement may result in up to 5 years imprisonment and $250,000 fine per item copied. While copying one song or a movie counted as one infringement, illegally downloading Microsoft Windows, for example, meant an infringement for each application in it: the calculator application, the notepad, the solitaire game, and so on. Young kids end up with multiple life sentences just for downloading pirate software over the torrent. Now I ask myself, did this move made by the music, movie, and software industry accomplish to stop piracy over the peer-to-peer network? No. Did the movie and music industry gain the sympathy of the general public, making arrest of little kids? No. They were too focused fighting the wine mills. If you don't get the analogy, go read the Don Quixote, a novel by Miguel de Cervantes. And they missed what I believe was a great opportunity: the possibility to sell all the ever created content everywhere in the planet, from big cities to the smallest village in remote countries, through a network they didn't even have to manage or pay for. They just needed to share via torrent, DRM, digital right management, locked content, provide free preview, and the means to pay them to unlock the DRM content. They had the perfect way to serve, and they missed it. As Bitcoin and with it the blockchain came along a few years later, they disrupted the industry. Wasn't the one of the music and film, but the world financial sector. I'm glad that this time the reaction has been different, as we see there is support for innovation in the financial sector when it comes to blockchain. So let's surf this magic wave all together, as there are tons of opportunity and we have a lot of work to do. Thank you for listening. Till the next time.
Your heart and you will feel proud. Save it in the blockchain, share it with the world. Permanent.
Hi, my name is Alinga, and today I'm going to talk to you about our latest international project called Purple with Purpose. People probably best know me as the director of the Center for Citizenship, Enterprise and Governance, which is a not-for-profit think tank. We're the world's leading not-for-profit, with a couple 100,000 members. And we focus, myself and my colleagues, on the dialogue around data. Who owns it? How do you transact it? How do you get value from it? And in that dialogue, we are often seen to compare and contrast. In the West, in West Coast, for example, people like Facebook and Gmail, Google, etc., believe that companies own your data. It's a Western philosophy. After all, they give you the products for free: Gmail, Instagram, WhatsApp. And so they say, well, we give you these products for free, so just give us your data. And we will then use your data to sell you more stuff. And they go also to influence the way you vote, because someone may have paid them to influence your ideology and to nudge you into that voting behavior. In Europe, we have a different approach. In Europe, we go, my data, my way, and It's resulted in GDPR, but all we do is hit cookie acceptance buttons 30 times a day. No one reads the terms and conditions. It hasn't really worked out, has it? In China, and I sit on the government committee from Ministry of Commerce. It's called the China E-commerce Blockchain Committee. And there they believe data belongs to the government, because they believe that government that is responsible for safeguarding society. And they say, look, we have 1.4 billion people in China. We have 72 BRI, One Belt, One Road initiative countries, 73 with Afghanistan. We cannot use individual rights as an instrument. We look after the corpus of society. And in that respect, they use fourth industrial revolution technologies that are data related, like blockchain, like AI, like Internet of Things, like 5G, as a way to actually monitor people and in their respect safeguard them. Now, I was very surprised to hear in February this year, 2021, from a guy called David Proud, who pointed out that there's a large proportion of society representing, a bigger community than the population of China, than many religions like Islam and Christianity. Bigger than those communities that actually whose data is not monitored or tracked because they're not considered to be of worth to society, which is extraordinary. And it's a real failing in our society, isn't it? That a huge proportion of society is considered so misaligned to the mainstream that they are not either assisted or safeguarded in the way they use their data. And it does represent, at the same time, simultaneously, a massive opportunity, which I think we should all grasp, because this is like a portion of the world which has been ignored. And that is, of course, the disabled community. The disabled community, whether it's physical, with mental health, visible or hidden disabilities, represents around 20% of the world's population, around 1 billion at least. And so you have to say, wow, how is it possible that in this day and age, a fifth of the world has been ignored in terms of their contribution to society, in terms of their validity in society, and that the fantastic resource that we have failed to capture. Yet it affects us all, doesn't it? I have disability in my family, immediate family, my own family, in my extended family. You will probably know people who are disabled, and you yourself may be disabled. Or it may be that you know someone, in the media who is recognized as self-identifies as disabled, and these are many well-known people, or even other people who are actually have disability within their families or extended families. So this is not a small issue. This is not a very niche problem. It's actually amongst us all, and it should garner all our support. How big deal is this? Well, in terms of spending power, UK recently upped their figure from 249 billion in a year to 274 billion. US represents something like $600 to $700 billion, and globally it's around $13 trillion of spend. Now, that's not an insignificant number, is it? And in any other sector, this would be considered an incredible untapped resource and would attract much attention. And it says something to our core values that we have chosen globally to ignore it. And I think this is something we'd like to redress. It's, after all, bigger than the Chinese market. And the retail sector, in fact, is very closely aligned to this new approach, this closure on ID, of identifying niche people and niche communities, getting to know us through our own data, and to have services and products which are aligned to our destination and what we value and to our values. And so they want to personalize their products to us because they believe it brings them greater loyalty as well. And we will call this purple loyalty moving forward. So our mission, overall mission, is that if data is used in the West Coast, in the West, for corporates to sell us more stuff or influence us, and in East to whether you want to safeguard us, and some will say control, then why not use our data through the Purple project to actually nudge society into a better place? Why not nudge us to better behaviors, better sentiments, better society? And so that is the essence of what we're trying to do. And we believe it will lead to much amazing steps in terms of circular economy, both financial benefits, of course, where retailers will be able to target and provide discounts to that community, but also then they will have more revenue streams themselves, and it will help us overall establish things like Purple Foundations who represent 20% of the world, but also, and perhaps more importantly, or of equal importance at least, a non-financial circular economy, which talks about our data, of our intangible data of kindness and customer ratings, and the way we view and treat disabled people, and the way they feel as they're being a game changer in our society. And so these circular economies, which can now be measured, transacted, and delivered, we think will be transformative in the way we go. So we have developed a project which will launch shortly in the last quarter of 2021, looking to do the pilot in spring in 2022, finalize the findings ourselves in autumn 2022, and then launch it properly following the findings to revamp in 23, and internationalize it 24 and go forward. And of course, it's a marathon, it's not a race. This is not a small thing. It's part of the United Nations SDGs 2030, so we want to get this right. We're not, this is not completely commercially driven at all. And some parts of it, ultimately we think 5G will have a great part to play, because you see, 5G is about data layers. And by data layers, I am talking about someone who's disabled, goes into a cafe and does not have to say, "Hi, I'm disabled," or show a QR code or self-identify, recognize themselves. The fact is, through 5G technology, they will know through that data layer has entered the premises. They will know they can get automatically the right discount, automatically the right services. And so as 5G rolls on, these things can be integrated far more into our society. And the team that we've brought together, we're really proud of, I have to say. The whole thing was inspired by David Proud, the founder, who's an award-winning writer, an actor in the UK, writes for the world's leading series on television called Coronation Street, which is like an institution in the UK, but has been going many years. And he inspired us to operationalize this, and so we were very happy to bring our services to his vision. People like Julie Fernandez, you will know from hit TV series The Office, and many others, have been brought in. Like Alison, who was heading up Citibank and JP Morgan over in Asia for many years, and Bill from the retail sector, from multinational, multi-drop retailers around the world, and including Simran, who is a lawyer focusing on compliance, legal, and risk, based in Singapore. We have Pamela, who focuses on, she is a mainstay in the Caribbean disability community and is looking at diversity in that area. Antoinette, who is bringing her finance and governance as company secretary and accountant to us, because this thing has to sustain itself and be sustainable and scalable with her skills. And Georgina, who is going to focus very much on the idea of microchips, which she's developing for the art sector as well. The idea of microchip came from something we developed called microshares, but now labeled as microtips, that we should be able to tip, not financially, but emotionally, other people through who make us feel better. And so we think the Purpose Project is at the core of that world-changing idea. We want to do a project, pilot project, first in Cambridgeshire. And that is Cambridge. You will know the city where the university is in the UK, and it will involve all the sectors: the public sector, local government, corporates and retailers, civil society, third sector, and of course the communities, including the disabled community. And the focus will be to test some of the outcomes of our thoughts and to find what works, what doesn't work, and from that we'll be able to provide a much better final solution going forward. This is a groundbreaking project, and it's in international dimensions. And we are looking for people and institutions, organizations to join us who want this to happen. And part of that is use of blockchain. I was the world's first professor in blockchain, and we back in 2017 dropped onto the market a new kinds of blockchain. Blockchain is a movement of digital assets from A to B. Many of you may know it as Bitcoin, but actually it's just a movement of any kind of digital asset. And of course, money is an asset. Bank, things like land is an asset, gold is an asset, diamonds are assets, but so is love, happiness, hope, generosity. And these are the core sentiments at the heart of the disabled community. And if we can get this right, the disabled community will be pioneers who make us feel better. And so we think the Purpose Project is at the core of that world-changing idea. We want to do a project, pilot project, first in Cambridgeshire. And that is Cambridge. You will know the city where the university is in the UK, and it will involve all the sectors: the public sector, local government, corporates and retailers, civil society, third sector, and of course the communities, including the disabled community. And the focus will be to test some of the outcomes of our thoughts and to find what works, what doesn't work, and from that we'll be able to provide a much better final solution going forward. This is a groundbreaking project, and it's in international dimensions. And we are looking for people and institutions, organizations to join us who want this to happen. And part of that is use of blockchain. I was the world's first professor in blockchain, and we back in 2017 dropped onto the market a new kinds of blockchain. Blockchain is a movement of digital assets from A to B. Many of you may know it as Bitcoin, but actually it's just a movement of any kind of digital asset. And of course, money is an asset. Bank, things like land is an asset, gold is an asset, diamonds are assets, but so is love, happiness, hope, generosity. And these are the core sentiments at the heart of the disabled community. And if we can get this right, the disabled community will be pioneers in the global change. Especially post-pandemic, this has become of greater importance. And so we developed a block of value which contains both tangible, hard financial value and intangible, soft, non-financial value. And we're suggesting we use this for the pilot. It may not be appropriate for the full rollout, but we've got to start with something which is compliant. We did it with the FCA, Financial Conduct Authority oversight in 2017, and so we believe in compliance. And the second aspect, of course, is this idea of microtips, of what we used to call micro shares, that the way we want a transactional way, not with money, but with acknowledgement of someone, the way someone in the disabled community has been treated by retailers and by society, how to thank, how it can scale from our thoughts through to our personal value and values, into the organizations we operate in, into the regions we live in, into the nations that represent our values, and into the world as a whole ecosystem. And this is, I'm excited that the disabled community can be the heart of a change in society. And this change has become more important since COVID, hasn't it? COVID shocked us all that money actually isn't the most important thing, if of no use if you're dead, and that health matters more, and that our families matter more, and spending time at home matters more, and being out of cities matters more. And so it has changed, and we think this is aligned to the new value sets post-COVID-19. And so that we don't spend time all on development, we are using an existing retail ecosystem which we developed in 2018, at the end of 2018, which has QR codes and mobile apps and loyalty discounts, gift cards, etc., based on blockchain technology. And we will use that to learn in the pilot what works and what doesn't work, and discard items of it that are no longer relevant or not compliant with legals these days. Finally, the project itself, financially, is a not-for-profit project, so half of it, the contributions will go towards the foundation we wish to set up, and about a quarter through our operations, and a quarter to the investors who are going to make it happen. And of interest here is this concept of setting up the Purple Foundation by 2025 or soon after as a DAO, a distributed autonomous organization. That's an organization without directors, without shareholders, without hierarchy, simply where everyone who is disabled in the world has one vote. And this, we believe, can be an enlightening idea of representation and democracy going forward in society. So I'm going to leave you with these words from David, who inspired myself and my team here at CCG. I'd like you to read it, reflect on it, and wonder if this is something you'd like to help and contribute to make a better world, where we can nudge through our data, into a better world. Because after all, the currency of the world is no longer money. The currency of the world going forward is data, sentiment, and ideology. And so this fits very well into our latest institute that we dropped onto the market in 2021 the Ideology in Code Institute, where we call it the home of total value, meaning both financial and non-financial value. We have been doing this work for over 10 years, actually, over a decade. And we've been doing it for many leading companies around the world. And certainly it's captured the zeitgeist of this decade. We feel extremely proud to be associated with the Purple with Purpose project. It represents the essence of what we're about. It is our highest achievement if we get this done correctly. And it excites us. We think this is a project worthy of us putting all in. We are certainly purposefully ourselves driven, as is this project. And we'd love you to join us to make this happen for the world and for ourselves, our society, and for yourself. Thank you.
Thanks for the invitation. Today, my topic will be about decentralized finance and what are the opportunities ahead. My profile, for most that know me, I'm a rather early adopter of blockchain. Right now, I'm the chairman, Asia for Big One Exchange. I'm also the digital advisor, chief digital advisor with Mongolia. I also hold other appointments like chairman for Esports Association in Korea. Also a non-executive chairman for EG Association that is driving social impact. And all these things are very much revolving around crypto, revolving around DeFi. And I have always been a strong voice, in telling people, what you can find within this whole DeFi market. What are some of the key areas where you might find some good opportunities. So I think right now, this is a fantastic time to be in DeFi. Driven by short and long-term drivers from the explosive growth of the NFT market, overtaking DeFi, and then of course there's a new breed of play to earn games or GameFi, to rise, and also there's a metaverse as the next big thing. So there's a lot to unpick, which is very exciting, to a lot of people. And especially if you are new in this industry, all these things seems to be really exciting for all of you. But let's start with some basics, for those of you who are new to DeFi. So DeFi is also known as decentralized finance. The system allows people to create financial products or smart contracts per se that execute actions automatically on the blockchain without any bank, brokerage, exchange, or corporation acting as the middle person. At the end of July 2021, the capital market for DeFi products was hovering around 80 billion. While that was down from its May peak of more than 89 billion. Many believe the growth will continue in the coming year as DeFi products mature. Key to that maturity process is innovation DeFi, creating opportunities to profitability shape a decentralized future you will sure to want to be a part of. And then if you look at the non-fungible tokens, or commonly known as NFT, the NFT industry has exploded. It is really popular this year. It has more than 2.5 billion in sales volume during the first half of 2021, and it has accelerated since. OpenSea, the most popular NFT marketplace, saw more than 3 billion in sales volume during the month of August. These are big numbers, really big numbers. So what's driving the demand for NFT? Well, the fact is that digital native would rather own digital goods than the physical goods, which means that we are watching the digitalization of the collectible industry. These digital natives want to use NFT as a way to play games, transact with each other, and recreate the collectible industry. Another perspective, as outlined recently by popular game or crypto podcaster Pom, is that we are watching the new birth of a new type of status. this is what he said. Each individual would normally drop $50,000 to $1 million to buy a car, a watch, maybe a house, a boat, etc. And is now realizing you can spend the money on a digital good and flex it in front of people on the internet. So only so many friends can check out your house and be impressed, but millions of people a month see your Twitter avatar. These NFTs are a great example of where I would expect billions, if not trillions of dollars to be made in the coming years. As Pom say, just as every business had to figure out an internet strategy in 1990s, every business is going to have to figure out their Bitcoin strategy. And every business is going to figure out their NFT strategy as well. I did also jokingly say something about chief Bitcoin officer for businesses, and then I was then interviewed by one of the largest India-based tech publication a couple of months ago. While it seems like a joke, in my perspective, chief Bitcoin officer, CBO, but I think, just like Pom, I think there is a need, to think about a better Bitcoin strategy for the company, and also keeping the company ahead of your competitors by getting yourself into the digital space. And that is and that is things that we should really look at, Of course, we are also looking at many different things, For example, like a newly publicly traded fund, Meta. Now you can actually get exposure to metaverse play that are traded publicly. These are things that are really happening in space. Looking at metaverse again, we are just maybe a few weeks ago, when Mark Zuckerberg, Facebook CEO, said, within the next 5 years, Facebook would be a metaverse company. While Microsoft CEO, say that they are investing in the enterprise metaverse. Simply put, whoever can integrate NFTs and payment with metaverse may well lead the biggest change in the online culture and economy since the birth of the internet in the 1990s. A view supported, by the head of Roblox Corporation. Roblox, I think, is about 50 billion worth right now. He sees the emergence of the metaverse as a profound shift and also an intervention of internet and the World Wide Web. Well, Roblox is and has been, the leader in this space, in the game space especially. In a close fit with the vision of an open metaverse, play to earn crypto games are built on the fundamental need for a place that is available for everyone and owned by no one in particular. GameFi, gaming and DeFi, a combination, right, came about. It is referred to the intersection between blockchain-based games and decentralized financial instruments in all their, in all the different terms, like yield farming, lending, staking, and so forth. This form another ecosystem, So crypto has been looking for a mass market use case, to be really honest about this. And gaming sector is definitely a very good entry point for people who have been hyping for a long time, who have been trying for a long time. It is the first area of crypto where average Joe, without understanding too much of crypto or blockchain, can participate. And this is a great entry point for crypto, to be real honest. And the rise of GameFi associated tokens has captured the attention of wider crypto market, especially in the longer term trend of NFTs and metaverse. The goal is to support developers and create GameFi projects by building decentralized content. I have been looking at a lot of all these different news in the market and so forth. If you look at the market, other industry leader, talk about NFT is going to be the next big thing that makes DeFi, NFT, together. GameFi is the one that connects everything together. Maybe another striking example on how the rise of GameFi is driving the value of tokens in the early August for XL Infinity. Well, they are a popular crypto gaming platform on Ethereum, which rake in more than 220 million in revenue in 30 days to early August, making it the top revenue generator among all DeFi protocol and blockchain, Ethereum included, according to the data from Token Terminal, if I'm not wrong. So this has changed, how people look at how people look at DeFi, how people look at NFT, how people look at GameFi, for example. Not surprisingly to this phenomenal price growth, it has caught a lot of new traders, and crypto market watchers' attention. XL Infinity has been on an absolute tear recently. The play-to-earn platform has become the face of a new integration of crypto gaming that holds to unbelievable potential. XL has surpassed 1 million daily active users and is generating more revenue, than many other protocols, or other major platforms. So this growth is really different. One of the key problems associated with such a rapid growth in the DeFi maybe in the whole DeFi ecosystem, is the increasing transaction fee, particularly the rapid increasing Ethereum gas fees. To address this issue, many projects in the crypto space are starting to offer cross-chain functionality. One of the most successful innovators in the space has been Polkadot. The price of a Polkadot governance coin has raised over to $30 from under $10 in August. This put Dot's market cap to be about 30 billion or so, about the size of Ethereum a year ago. Another coin that is worth noting is Solana, recently also listed on our big one exchange. As they are another Ethereum killer with lightning fast transaction at a fraction of a price. The rapid increase in value is largely a result of crypto gaming and successful NFT launches. Amid huge NFT sales resulted in a bull rally, for SOL, and its price has taken reach, trading at $1.60 during the start of January, and then smashing an all-time high at 194.82 cents on 7th September. So look at what we have seen so far. The opportunity has been very obvious, for all of us, those that are in the space right now, in the DeFi space, and also for new institutional investors, who are looking at new chances to get into the space. GameFi, decentralized finance as a whole, act as a very good bridge and entry point for all these serious investors to get in. Let me conclude this whole speech about the opportunities for everybody. I think opportunities are everywhere, for the crypto space. Many times it comes really fast and you might not be able to catch that. This is very normal. So all you need to do, is to get yourself in the space, understand the space a bit more, and then spotting the new trend coming on board will be a lot easier and a lot faster, than just than just looking at news, or depending on another a young guy or another advisor of yours, right? You, as a business owner or as the leader of your company who is looking at innovation, who is looking at driving new opportunities for your company, you and yourself got to be in the space. If not, when people tell you about GameFi, you will say, what is that? When people tell you about staking, you didn't know the mechanism behind it, right? So you have to be in the space to understand what it is. And again, I always try to also warn everybody that, you need to do your own research. Do your own research before you get yourself into any form of crypto investments or crypto buys and so forth, because you have to be responsible for the things that you have done, for the investment that you have made, for yourself and for the company. So please, talk to the right people, get the right trend, and the doors to new opportunity will just be really, really around the corner. So with that, I'm going to end my speech. And thank you very much for the invitation. And if you have anything, if you need to reach out to me, you could reach out to me via my social media. Or you could reach out to my Big Ones team, and we could definitely share with you a lot of new opportunities and new insights. So thank you again. Thank you so much.
Good afternoon or good morning, and a very welcome to this event and to my presentation. Today, I would like to start thanking the organizers for putting together this conference and the whole American Digital Week. I'm very glad to be part of the event today. And with that, I would like to start getting into the presentation of today. So we talk about the importance of data analytics for a customer-centric fintech operation. So we will start with some high-level overview on overall on fintech and the role of tech in the space and what solutions we can develop from that. Then we will do a little bit of a deep dive in some tech aspects of it. And finally, we will show a couple of case studies. And with that, we will sum up and give some summary and some outline for the future. So with this brief introduction into the whole event, I would like to start. And okay, so let's start with customer centricity, a catch-all phrase these days, a buzzword which every good consultant brings to the table when talking to clients. But nevertheless, there are some very important aspects to it. So it is basically the idea of transforming your business to a customer-centric business, in the sense of empower your employees with a single customer view, a 360-degree view on what is your customer doing, what are his needs, and how can you serve ultimately the customer better and improve your performance. And obviously, this kind of holistic approach is very much enabled with new technology coming up, like call it the cloud, IoT, open banking, machine learning, big data. These are all aspects which are shaping the financial industries today. And while there's a consensus that these have dramatic impacts on the financial sector, there are also, of course, challenges, pitfalls, you name it, and you have to leverage your strengths and your capabilities according to it. And obviously, when we talk about the whole banking and finance sector, fintechs, I already mentioned the term open banking, while not very new, but they are still a very disruptive force, and they are often also bigger and faster adopters of technology, and that's what we want to focus today a little bit. Now, when we talk about embedding data analytics, or what is data analytics, or why is it so important, and how do we go about it, I think what we try to show here, and this is our the way we approach any data related work with our clients. That's again, so to speak, from a data point of view, a little bit of a holistic approach, where you have from the data operations via data engineering, feature engineering, to the actual data analytics, and the very next or last step would be then your data science. So the important thing is that all these aspects are crucial, and while some of this is already happening in some organizations, some of these are also things which companies want to keep in-house or want to do themselves. There are always certain interfaces or certain parts of it which might need some further help. And the other thing is, what we also often see is that and that's why this chart is still so important and so powerful to show, is that there is a logic behind that, and this logic is sometimes not followed. I mean, when you talk about IoT, data analytics, AI, ML, which are all big buzzwords, as I already mentioned, a lot of people want the AI without the data operations, and that's not going to happen. I mean, it's much more complex. And while it's nice to build models, it's nice to have a predictive tool, if your data, if your unstructured data is not cleaned properly, converted into meaningful insights, your predictive model will ultimately not really work. And that's why you should always keep a model like this in mind when you do a data project. And as I said, some things you might want to do yourself, some things you might have already in place, but for some things, especially in the operations and data engineering part, because it's not covered with buzzwords, it's not as they call it, as sexy as the data science part of it. Sometimes it's get neglected, and that leads then into problems later on when you want to deploy your model. So that's why this is it's a very powerful slide and a very important aspect in your operation. Now let's talk a little bit about fintech. As I already said, fintechs are a little bit the disruptors of what's happening right now in the industry, and they are also faster adopters of technologies. They are also have reached a certain sophistication in methods to reach, engage, and retain customers by using modern technology, but they also use, but they also are then able with sophisticated modern loan and credit management to attract and to approach certain clientele which your conventional bank is not ready or cannot serve as appropriate as a fintech. And many of these things are driven by technology. I mean, there's a lot of thing in this world where we, for instance, see a move toward non-physical or virtual channels, including mobile channels, chatbots, automation techniques. And the interesting part when we talk about these technology things, like for instance the chatbot, it's one is the interface with your client. You can be faster, smoother, interact with your clients, but at the same time, every interaction, every virtual interaction, every tech interaction, be it in the internet, be it on the mobile, be it wherever, it creates data, is a data point, and this data point can be saved and stored somewhere and later on be used in your analytics. So I think that's one of the big changes in the industry, and where fintechs are moving ahead faster than some of your regular banks. Regular banks still operate branches, and just to take this example of the chatbot to the branch, if you go to the branch and have an interaction with your customer relationship manager in a face-to-face meeting, it might be helpful for you, but it doesn't generate as much data points as if you do it on a chatbot, because the CRM, the manager, the customer relationship manager might not take notes, he might not fill in the CRM tool properly. It's just a quick call or whatever. It's not as in a chatbot where really every single line of interaction is saved and is a data point which can later on be compared and analyzed, and you can run through it again and develop this as your model. So with this, I would like to showcase from a client relationship or how specific on the client relationship management tools, and how you increase your client, the value of your clients on a three-step kind of approach. This customer base scan, the definition and launch of initiatives to drive value, and the capabilities in the order to build up. And when you look at the customer life cycle, so there are mainly three big stages. What you have the acquisition, the activation, and then the relationship management, the cultivation. And when we start with the acquisition for new clients through big data, there are certain aspects to it, like your efficiency of your marketing tools, then the segmenting of your prospects based on public available information already to determine the best channel mix for marketing campaigns, personalization of marketing messages, that's your optimized contact optimization, prioritization, monitor what customers say. I mean, the direct feedback, the direct interaction with your clients, that's what we kind of already mentioned earlier. And last but not least, identify the influential or the high profile customers. And with that, you would then go to the next stop or position of the activation of your again, you will use the segmentation of your customer based on the available data and get real-time customer insights. This allows you to predict ultimately the products or services customers are most likely interested in a predictive analytics tool for them. For could be a purchase, could be a home loan, could be a car loan, and based on that you can then bundle products better and boost your cross selling. And we will talk about it in a bit, and optimize, of course, also your pricing ultimately going forward in serving your clients better, and also, of course, making sure that your bottom line is kept intact. And that leads then, as I just said, to when you roll this out to opportunities of cross-selling and upselling opportunities along the whole value chain. And there are countless examples on that, so that you have when an inflow of cash is, you offer an investment opportunity. If you see that customers are simulating on your website car loan facilities, or on the internet, even if you can track that, you can offer him a car loan. You know that he's looking for car loans. So if your customers has an expiring term deposit, you can well in advance make an attractive offer of reinvesting the money, and things like that. So that's on the cross-selling front, where we so the ultimate benefits, as I said, in this world, if you have this kind of customer-centric approach, ultimately is you drive growth of your business. You have a better risk management because you have the better identification, assessment, and prevention of and mitigation of risk, and ultimately you reduce and have better control of your costs. That's, of course, also in any organization, efficiency is always a big motivator to implement technology. Wow, this is an impressive slide, I guess, and I would have loved to show this in a live conference and look into your faces and see how you can digest that. It's a very well packed and full slide. And why did we keep it here, or why did we put it like this here? That's because a lot of the things what we talk about seem to be logical and natural and fall into place automatically. And at the same time, when you look at a lot of technology or a lot of technology solution providers, especially when it comes to data, it is always sometimes a little bit sold as a how to say, as a black box. No, so you have data coming in and you have results coming out, and what's happening in this black box is sold to you as a secret sauce or whatever. And it's not, especially if you're not from the tech side, it's sometimes not as logical or as obvious that there's a lot of work, there's a lot of technology, there's a lot of layers of complexity behind a data project. That's why we wanted to keep that here, to have the tech aspect here, and to show that it's not as straightforward as it sometimes looks in with buzzwords and with tech presentations, but it's also doable. You don't have to be scared of it, and it is also very important that a step-by-step approach is critical to have ultimately the results you want, and which is basically your customer retention, your cross-selling, we already mentioned, the customer lifetime value, customer segmentations, or just basic information on management dashboards. And with this, I would like to talk a little bit on some case studies which we have done recently, and then sum it all up with some summary and way forward. So here you have a predictive model for financial services, which is basically the it's a provider of loans, and they wanted to understand what's the risk assessment. So in order to price their products more aggressively and also more secure, reflecting the various risk factors as well as the potential of their various clients. So hence they needed to ensure that the cost of selling to incorrect borrowers and repayment losses are reduced at the same time that they find out the well performers to be more aggressive. So the problem was solved in using a technique called vintage loss curves and net flow rates, and with that we were able to have a charge-off rate reduced by 18 to 17%. Since it was a fintech, we helped them with this tool, and that is especially in the fintech speak was very important. We helped them to onboard a new investor because they believed in the stability of this predictive tool and of the risk mitigation which the company can do using this kind of advanced analytics tool in their day-to-day operation. The next one is for that. While it's a banking client, it's a lot of things what we've done there or what we do there is of course also applicable for any operator in the finance space, and that's why we kept it here. Basically, what we are trying to say here is that we wanted to develop a lifetime value model and identify upwardly mobile customers. I mean, as we already said, customer lifetime cycle. That's a very common, in many industries, used application for data. And again, if the more data you collect about your customers, the more precise, the better you can develop your scorecards. Basically, what we did here is you developed a scorecard of the vast variety of your client portfolio and bucketed them into different categories of clients, so that for your ongoing strategy going forward, you knew where to focus on. You knew also which client base has to grow because that is more profitable for your organization. And also to improve what we already mentioned before here, your marketing mix, and make sure that you target the right clients with the right products and with the right solutions. And here's another more fintech related company. That's a company in the B2B payment space, and so here the job or the work was very much before you do any predictive tool. What we also explained in one of the original slides is to create first a data platform for them, because they had a huge amount of unstructured data, a lot of manual processing of data, and at the same time when they did the manual processing, they had no access to historical data. So the idea was really to create a data lake which has multi-levels access, but with a single source of truth. So it's one data lake, and depending on in which department you have the same access to the same data. So that means also your while your conclusion, because you're in a different department, can be different, but you work with the same data, and ultimately it all ends up together to have your overall performance, your overall productivity going up, and you have also certain data securities for you to work with one set of validated data across the whole organization, which makes you faster. And when we talk about faster, and when we talk about real-time and easy data access in the payment, in the fintech space, we should always look at the whole transaction volume a company is handling, and every day you're faster, or every time you get faster, if you get real time, is pure cash for any of these companies, because the sooner you know what's happening in your organization, the sooner you know whether you have to take on money or whether you have to invest money. So any improvement in your turnover, any improvement in your reaction time, that what used to take you a couple of days to reconcile is now instantly. For these days which you save, you should always put an interest figure on the whole transaction amount, because that's the amount you're talking here about, which you either lose or gain depending on how fast you can react. And obviously in real time, nothing better than real time as a reaction time. And with that, I would like to conclude here and give just talk a little bit in summary that these are things which are already in place, but there's of course much more which data and finance can do together, and that's why especially when you plug in IoT solutions. So that's why, as a summary, I would like to give some examples on what kind of new innovative products and services you can offer to customers. And one could be home insurance in combination with IoT. So that means you have smart meters, smoke, carbon detectors, alarm systems that allows a higher protection of property, and provide value-added services like statistics on utilities and consumption, and subsequently a better insurance product, or also finance product at the same time. Even if you go for a home loan, it can be much more sophisticated or much more tailor-made if you combine it with IoT structures. Then you have car insurance that's already quite widespread, where you also use IoT devices, and you have the kind of a usage-based insurance product. Trade finance contracts in combination with IoT, like supply chain sensors, allowing automatic execution of contractual conditions defined in a contract. That's especially in cross-border transactions. It's super interesting if you know where your container is, and if you have secured an export finance through an LC or whatever. It's you have again real-time access to the data, and that can make the product more sophisticated, but you can also make it price it in a different way. Then personal wealth management, we have already mentioned that to a certain point, and ultimately one big point could be also algorithmic trading. That's high and about, where you actually say, okay, with using an algorithm can be better than having an actual trading partner on the phone that can give you much more tailor-made suggestions. And with this, I would like to conclude here, and I hope there will be some further interactions after this, and I hope it was to a certain extent useful or insightful for all the listeners. And again, thank you very much for having me, and yeah, thanks, and yeah, let's keep discussing.
History has it, 2,000 years ago, 30 pieces of a similar silver coin sold out a god during his Last Supper. When the barter system for exchange of goods proved inefficient, empires, dynasties, emperors started minting coins to be able to trade their goods cross-border, to be able to pay for goods, for the order to pay salaries for soldiers, and even to collect taxes. Minting and transporting gold was too costly because of sinking ships, pirates stealing this money. Silver was used instead, and gold was kept as a collateral for this money. Centuries ago, China was the first country to use paper money. Paper money is a legal tender, just like the coins. However, new challenges has arisen from using this sort of money. Good day, everyone. Today we are going to talk about the importance of a central bank digital currency in a post-COVID-19 world. My name is Elias Taya, and I'm a certified Fintech professional and an international consultant for financial technology companies in the Middle East and North Africa. First of all, I would like to thank the Digital 4 Foundation for giving us this opportunity to address you all. And I would like also to take the opportunity to thank all those who were on the forefront fighting the COVID-19, from nurses, doctors, healthcare providers, and everybody else. So thank you. So how come a digital currency is important in a post-COVID-19 world? Before we go into that subject fully, let's go back to the 2008-2009 financial crisis that affected the financial institutions, the stock exchanges around the world. Some countries like Iceland were swept away financially. And after that, we have seen another severe crisis in Greece, followed by another crisis in Cyprus. Recently, we are facing a very severe financial crisis in my country, Lebanon. So what a central bank digital currency could change in all that? Why is it important, especially in America, since we are addressing this question today for America? As we have seen before, money is crucial. It's crucial at economical level, at all levels. And the financial inclusion, especially in third world countries, in South America, has been very slow, to say the least. Commercial banks are not really interested in reaching the last mile customer in these countries, probably for many reasons, but it seems that this didn't happen, or it happened inefficiently. And in the other countries who were hit by financial crisis, they couldn't really, address the needs of the last mile customers, let's say customers, even though these are humans, people, So COVID-19 came out of the blue. It's a pandemic. It affected the whole globe, especially in the vulnerable countries that has big percentages of population who are unbanked or underbanked even. Countries like in India, they tried to distribute subsidies through their existing channels. They used the Fintechs, the Aadhaar system, and other channels as well. They were fairly successful doing so. The same happened in the United States and in North America in general. Governments distributed subsidies either through plastic cards or bank accounts. But when there is a pandemic, basically commercial banks are closed and people are afraid to touch an ATM to go and withdraw money. So there is a risk. And not all of these people basically have access to digital money. They don't even have mobile money or an e-wallet on their phones. They didn't even know how to use it. At the same time, China has been leading the race to a central bank digital currency. They have been doing so for like a decade. And after COVID-19, they proved efficient in providing minimum finances for their population. It wasn't really official yet, but whatever wallets they have, whatever digital money they had, it was useful, and it was successfully providing means for people to be able to go through this lockdowns and the whole situation during the COVID-19. We have heard recently central bank officials in Europe, at the international level, even at the BIS level, addressing other central banks and addressing regulators and parliaments, congresses, officials at all levels to at least explore or try to find a solution for when there is a disruptive event, that people would still have access to a certain minimum of money, of currency. This is not an easy thing to do, regardless of the technicalities, which can be sorted out. There is a huge political question that needs to be answered. Because in these countries, mainly democracies, they have to address this question first, put the regulations, and then the technicalities, can really solve the problem. So the importance of such a solution could be a life changer for people at all levels, even for not just institutions, for small and medium enterprises. They could, still be able to transact at a certain level, not lose their whole businesses, not send people home and tell them, okay, we're closed, we have went broken, we have been facing a financial crisis, we have COVID-19, we're sorry. So what can people do at this level? If the regulators and the officials at Congress level, like I said before earlier, and probably parliaments, ministries of finance, central banks could not find a solution, revolutions could take place. And this has happened, not probably to an extent where a regime change has occurred, but it has happened when people need their money that have entrusted these commercial banks and the central bank to preserve it for them or to invest it for them. They will most probably be very furious, and it's rightfully so. A central bank digital currency basically eliminates the middleman. By definition and by operationally speaking and technically speaking, it doesn't really need a medium channel, even though these medium channels could still exist and play a major part in the distribution of such money. Let's put it this way. It could still reach the last mile customer. That's the importance of it. From that kind of perspective, people could still have their funds within reach. They could still have access to some sort of purchasing power for them to be able to go through this kind of event, like a pandemic, for example. On the long term, this could play a major role in the transformation to a digital economy, to a global digital economy, which is happening. Technology has always been a catalyst of change, and now it allows this kind of solutions to become effective. And people don't really need to be geniuses to be able to use it. We have seen major changes happening in Africa, in Asia, in South America regarding the use of mobile money, whether it is issued by a telco or a commercial bank or whatever. Millennials are even going one step further. They are using cryptocurrency, which is not a legal tender like a fiat currency or the currency that is issued by a central bank. They have been exposed to this early, very early, and they are using it, making money out of it or losing money out of it. It doesn't really matter. I'm talking about the technology and the use case. So at least in every household, there is somebody who could help somebody who is probably older, who couldn't not just use it, probably they don't have the time or the will to use it. And once somebody shows them how to pay or receive money through that kind of channel, I'm sure they will be able to do at least very few and very basic transactions that could make their life easier. Apart from that, a central bank digital currency basically provides another solution at another level, especially for countries who have very big percentages in unbanked populations. A central bank digital currency can establish credit scores for the last mile people. It can help them grow their businesses in a normal day. It doesn't have to be during a pandemic or a disruptive event. Once the end user gets to using this kind of currency, the digital currency, and the central bank or an outsourced solution looking at this data, they would have valuable information about the behavior of this person and allow them to directly have access to finance. Those who have small businesses and they couldn't go through the bureaucracy of commercial banks, now they have the potential of growing their businesses. Startups, innovative idea, even creative people and artists, now they have the potential of doing something valuable, grow it through the financial data that they are providing directly or indirectly. Apart from the credit scoring challenge, central bank digital currency is going to provide real solutions for service providers. If we take the insurance industry, if we take other service providers industries, most probably they need such a solution. It's not just like a new channel. Though this channel is not going to eliminate in part or completely the other existing channels. I'm sure people would still use fiat currency and even paper money. And most probably some merchants will still hold that suitcase full of cash before they do some kind of a transaction. Other people might still be using checks and plastic money. B2B is already using digital transactions for their businesses. So digital currency is going to allow them probably to penetrate new markets or to be able to be competitive in certain markets. It's not going to eliminate something that is already established, but it's an additional channel. I think we have raised enough points for an interesting debate in a Q&A session. I hope you enjoy it. Thank you.
Hello everyone, my name is Pavel Kaminsky. For the last 15 years I have been dealing with information security in its many phases as an auditor, pen tester, but for the last 5 years I'm a QSA, Qualified Security Assessor, certified by Council to do security assessments for companies that work with payment cards. A few words about us. 7 Security was founded in 2014. We are operating mostly in Europe and EMEA. We have our own implementation and pen testing teams, and, which is very important, 80% of our customers did their PCI DSS for the first time with us. So we very well know what were their expectations, and of course they were looking us for their PCI DSS certification, which, as you know, doesn't exist. What is PCI DSS? PCI DSS is a security standard that is developed by PCI Security Standards Council together with payment brands and is applicable to any organization which either stores, processes, or transmits the cardholder data. So even if you just transmit the data, it's already enough in order to have the obligation to be compliant. PCI SoC was founded by 5 payment brands: Visa, MasterCard, Amex, Discover, and JCB. This is a good example in the history when competitors actually do a partnership in order to create one security program, so you can comply with that program and work with all of them under one license, let's say like that. PCI DSS has 12 requirements or 12 groups. As you can see on the screen, the first group is about your network security, firewalls, routers, network segmentation, and so on. The second one is about your systems, how you do systems, how you do system hardening, and so on. The third one is about storage of the cardholder data, encryption, storage rules and controls, and so on. The first one is about transmission, how you transmit the cardholder data, TLS, VPNs, encryption. The fifth one is about malware protection, how you do antiviruses on your systems. The sixth one is about change management and development procedures and vulnerability management of your systems. The seventh one is about data, restricting access to the cardholder data by business need to know. The eighth is about identification and authentication, or how you do access control to your in-scope system components. The ninth is about physical security, video surveillance, logs, and so on. The 10th is about logging, monitoring, and alerting, what you should log, how you store the logs, integrity monitoring of your logs, log review daily, and so on. The 11th is about security testing, vulnerability scanning, penetration testing, file integrity monitoring, intrusion detection system. All of these controls are here. And the 12th one is about maintenance of information security policy, which is a cornerstone of your information security program. It's about acceptable use policies, incident response, disaster recovery, HR procedures, risk assessment, and so on. In order to be compliant, you have to implement all of that requirements in your organization. There is nothing about the certification here, as you can see. And why this is all important? So, if you are compliant, this is obvious. But what happens if you are not compliant? Security breach costs a lot. You can be suspended from processing card transactions, or you can face higher processing fees. But what can happen if there is a breach? Again, you can do nothing, probably, and everything will be okay until there is a breach. If there is a breach, you will probably face non-compliance fines from payment brands on your bank. You have to read your agreement with them, by the way. You will probably need to hire a PFI, Payment Forensic Investigator. This is a special company, special license for the company. So a PFI, like a QSA, will come to your premise to conduct an assessment on your environment in order to investigate the cause of the breach. You will probably face with some dispute resolution costs and card reissuance penalties. You probably remember that sometimes a bank calls you and said, okay, we want to reissue your card. It's free for you, just come to our office and get the new card. Banks, of course, this has probably happened because of a breach. So if there was a breach and your card was there, so the bank has to reissue it in order to save your money, or their money if it's a credit card. Yeah. But banks, of course, are not happy to do it for free, so they will probably try to get that money from the company which was the cause of that breach. So you probably will have face some actions from such banks that have to reissue their cards. And there are some breach notification codes that could happen according to your current laws. Again, there is nothing about the certification here. Every brand has their own compliance programs, and they are responsible for the compliance program enforcement. And every payment brand defines its own forensic investigations. Compliance program include tracking, enforcement, penalties, fees, validation process, who needs to validate, approval and posting of compliant entities, and definitions of merchants and service providers. Again, there is nothing about the certification here. So you don't need to get certified. You need to get compliant and to report your compliance in several ways. There are basically two ways. So to report it with a ROC or SAQ. With ROC or Report on Compliance, this is the document which is applicable to level 1 assessments only, should be prepared by QSA after an on-site assessment. SAQ is a self-assessment questionnaire and can be prepared by you or together with QSA who can validate it. And AOC, attestation of compliance, this is a short document around 20 pages long that you have to prepare in both cases at the end of your reporting. PCI DSS has two types of companies, merchants and service providers. As you can see on the screen, only the first level is required to report with ROC by QSA. The second level can do SAQ, self-assessment questionnaire, and QSA can participate in that self-assessment. Let's look at that documents in more details. The ROC reporting document has a predefined format, as you can see on the slide. It should be produced by a QSA, and it includes descriptive responses on controls testing. You can see on my screen report findings here. This is where your QSA has to report in detail what happens in your environment. The ROC should be done after a mandatory on-site assessment. So usually a QSA has to visit your in-scope locations for a number of days, let's say for a week or a couple of weeks or so, and prepare that. You can see the ROC template in PCI DSS document library. It's available for free. The standard is also available for free, by the way. Another document is SAQ, if you remember. It's applicable for level 2, which, if you are a service provider, this could be applicable for you if you process less than 300,000 transactions annually, or if you process less than 6 million transactions if you are a merchant. But again, if you remember, every payment brand has their own compliance program. So it's better to go there and ask what level of compliance you have to do and what documents you have to use in order to report your compliance. SAQ is structured in three sections: assessment information and executive summary, self-assessment questions, and validation and attestation details. Again, you can get it from the PCI SSC library. It's available for free, and it could include a QSA acknowledgement, so you can hire a QSA company to participate in your assessment and in order to make sure that everything is okay. It contains absolutely same requirements as in ROC, so you have to implement absolutely same standard, absolutely same requirements. The difference is only in the reporting. And AUC attestation of compliance. This is like a declaration of your PCI DSS self-assessment or a QSA on-site assessment. You have to do it in any case at the end, in case of SAQ, or your QSA will do it for you if it was a ROC assessment, on-site assessment, and sign it for you. And AOC can be submitted to your partners, to your clients, or to payment brands in order to attest your compliance. So actually AOC could in some way be your certificate. Let's say like that. Remember, there are no certificates for PCI DSS. If you see such certificates on the walls or somewhere else, they do not attest the compliance. This is a marketing, and you should not accept them. Just to recap, PCI DSS compliance is applicable for all organizations which either store, processes, or transmits the cardholder data. It's based on level and type. A level is based on the number of transactions performed annually. If you remember, for service providers, there are two levels on level 1. You are level 1 if you process more than 300,000 transactions. You are level 2 if you process less. Or for merchants, you are level 1 if you process more than 6 million transactions. From 1 million to 6 million, you are level 2, and up to 1 million, you are level 3, and there is a level 4, I think, before 300,000 or something like that. But this is not a formal information, so every payment brand has their own compliance program, which is enforced by them or by their customers who are issuers and acquirers. So probably your acquiring bank can tell you what type of compliance you have to do and what type of document you have to provide them in order to report your compliance. The type is defined by how your organization takes payment cards. You can lower the type of your compliance, let's say to SAQA if you outsource all of your e-commerce transactions, or if you use P2P certified POS terminals or something like that. You can find all that information on the council website. And depending on what type of organization you are, you will have to address anywhere from 20 to 360 PCI DSS controls. And depending on what level you are, you have to report your compliance with a self-assessment questionnaire or with a report on compliance by QSA. Some common PCI myths. We don't have enough card transactions to require compliance. It's obviously not true. Even have a few cards, you already have to be compliant, and you have to implement PCI DSS in your environment. Depending on the type, it could be from 20 controls only, but you have to do this in any case. We outsource card processing, so we are compliant. That's not true. Even if you outsource everything, you still have to implement PCI DSS in the set of requirements which are managing the outsourcing process. For example, requirement 12.8 requires you to manage your service providers, where you outsource your card processing or cardholder data, or share the cardholder data, so you have to control their compliance, you have to keep your agreements with them, and so on. We even have customers who do issuing, who do acquiring. So they issue cards, they provide payment gateway, they provide payment processing and other services. So like one normal bank, but they don't have any system, any server in scope, because they outsource everything. In this case, they should be assessed at least for the requirement 12, which is about their risk assessment, which is about how they manage their service providers. This is about their acceptable use policies and so on. And of course, incident response. PCI is an IT issue. That's not true. PCI DSS is a very technical standard, but it's not about IT only. It's also about your operations. PCI is unreasonable difficult. I would not agree with that. Everything depends on how you implement that. I would advise you to not think about something absolutely new and unusual for your organization. I would advise you to get focused on your already running processes and to make them compliant and to make them useful for your organization. If you are a small company, you can just create small procedures. If you're a bigger company, you will probably need a bigger procedure, but try to do it as less as possible in order to keep it manageable. That's what we always advise. PCI certificate allows us to store cardholder data. PCI certificate doesn't allow you to store the cardholder data. Yeah, that's obvious. First, it doesn't exist. We already know about that. Second, you have to implement PCI DSS standard if you even just transmit the data. You don't. This storage is not a requirement for PCI DSS. If you remember on the slide with 12 groups, only third group was about storage. And we are not a target. Believe me, you are a target. Especially small shops, small service providers, which can have problems with the security, and hackers are looking for payment details all the time because they represent a real money, and their idea is to try to hack your, let's say, website in order to get a copy of all the cards without you even notify them. That's why PCI DSS exists, in order to protect the most valuable payment information of your customers. Thank you very much for your attention. Keep calm and get compliant.